Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey, everybody. Welcome to another episode of Retirement Rescue Radio. I'm your host, Nate Miller. And today we're going to be talking about riding market highs and also some of the things that, some of the pitfalls that could come with market highs. As we know, the old saying of what goes up must come down, right? And so we're basically going to talk about how to approach these from a mindset, how to think about market highs, how to think about volatility in general, really. And I'm going to be going through a new white paper called Riding the Market Highs. And so if you do want this white paper when we're done, just go ahead and click on it. There should be a link in the show notes. If you're listening to this on a podcast, there should be a link in the comments or the description section, maybe if you're listening to this or you're watching this on YouTube. And so the key takeaways for today are going to be one, with the recent volatility that we had with the coronavirus, we know that markets rebounded pretty significantly and pretty quickly after that sudden plunge in February and March of 2020. And it reminded investors of the importance of focusing on long-term goals rather than just short-term events. So we'll be talking about that. And we find a lot of times that investors can kind of get, caught up in a let it ride mentality when the markets are just continuing to post all-time highs, kind of like what they're doing again right now. We're recording this right after July 4th weekend. And I don't know if this is a great analogy, but my son got his first time on a tube behind a boat. We got some friends that have a boat. And so he got his first time in there. I had to be in there with him though, because apparently with the way it was pulled, if you didn't have enough weight on the backside of the tube, it would pull the tube under the water. So we needed more weight in the backside of the tube in order to make sure that it stayed out, but it was fun. But anyways, yeah, you can see as you're being pulled in this tube, you can see when you're on the top of the water, but you can see like little dips down. So, when you're going down, you're going to be, riding this wave of the ups and downs. But the thing about the tubing is you can actually see the ups and downs coming. We can't always see the ups and downs coming in the market. And so since we can't predict when the market is going to drop or how far it's going to fall, we've got to have steps that we take to position ourselves against the potential risk of market volatility or big drops in the market during the times of growth. So when things are going well, what are some things that we can do to position ourselves from that inevitable crash? Because the market is cyclical, right? Future volatility could be one of the biggest threats to your portfolio. And logically, we all know that markets go up and down. And if they go down, it's not going to be permanent. We know that, right? And history shows us this as well. And so a well-balanced portfolio can often be our best defense against those market drops. But what's interesting, when we're thinking about our mindset here, it might be challenging to sacrifice some of your near-term gains for better overall long-term results. It's very, very difficult to do. If you're seeing the market just go up and up and up, you're like, oh, last year I did 10% or last year I did 20% or something like that. Yeah, that's great, but you could get wiped out in the early 2000s or even 2008, and where half of the market basically just lost its value. And that's great if you got a long time horizon before you retire, so you can make those gains back. And we'll talk here in a little bit about kind of the average time frames that you can think about when different market drops happen, like different percentage drops. How long does it take to come back? And if you're in retirement, you may not be able to wait that long, right? And so even following the Great Recession of 08, 09, markets enjoyed about 8 to 9 years of just incredible growth and low volatility, actually. And the relative calm lulled a lot of investors into a false sense of security, with a lot of them forgetting the pain of the losses that they had just, literally less than a decade earlier. And so when 2018 came around, that may have jolted some awake, but then volatility reared its extreme ugly head in February, March of 2020, where the S&P posted its fastest 30% drop ever, fastest, right? And so markets came back right after that, pushed upward by the optimism of vaccines and stimulus packages and, the economy opening back up. But we shouldn't forget the lessons that we learned, and we should take steps in order to make sure that we're protected against future downturns. And so the decade-long bull market of the 2020s eased the pain that a lot of investors felt after 08, 09, after the financial crisis. But like I said, reality did come back in 2020 with the COVID-19. And that wasn't just here in America. I mean, that was global right there. And that left a lot of investors stunned, searching for reassurance that everything was going to be okay. I remember a lot of the phone calls that I had with a lot of our clients. And yeah, we had to remind everyone, it's like, no, we expected some type of a downturn to happen, so we had already taken steps, right? So boom, you're good. And that's the importance of this. Steps had already been taken, and the majority of our clients didn't have to change anything. And those that did was basically because their comfort level had actually changed. What they realized their risk tolerance really was during this, decade-long bull market was actually very different once they started seeing, their accounts go down, right? And so that just means that we just had to rebalance. We had to reassess what was going on and where they were at to align their future with what really happened. They're really, what their feelings or their attitude towards risk really was. Because yeah, you can forget what your attitude towards risk is when the market's been going straight up for the last decade. You don't realize how much you don't want to see that go down, right? So here in a second, let me get started here real quick. All right, so first thing we're gonna go over here, and what I'm gonna do is I'm gonna go over a little bit of this white paper, but then I'm also gonna go through some other sources that I think shed even more light on this whole idea of volatility and just riding the market highs and what to do to position yourself so you're not so vulnerable when the markets turn back around. All right, so the first one, between 1980 and 2018, we experienced 13 market corrections. Now, I got to define what a market correction is, because, you got a pullback, you got a correction, you've got a bear market, right? So the pullback, that is basically just like anything from 5 to 9%. A correction is a 10 to 19% drop from the original market high. So a market correction, a market pullback of 10% to 20, let's just call it 10 to 20. That's an average of one every 2.9 years. That, 13 since 1980 to 2018 was 13. One every 2.9 years, you can expect to have a drop between 10 and 20, right? So that is pretty often, right? And during that same period, though, where there were 13 market corrections, the S&P still averaged 12.65% during that time. And that includes those years that we experienced those corrections related to significant global events and even a couple bear markets in there. And so the key takeaway there is that, market highs have been followed by lows. And they will do so again. And while some recoveries take longer than others, history does show us that markets generally will recover from that correction in about 4 months. So if we lose our 10 to 20, so if we don't go over 20, it's just the 10 to 20, we're going to regain that back within 4 months. Okay. So that hopefully anybody that has any reservations about if the market goes down right now, like I said, we're recording this July 6th of 2021. And after the coronavirus happened, we've kind of been on an upswing. Matter of fact, the markets have been doing very, very well in 2021. The markets are up double digits, mid-year here. And so that's great. And a lot of people are wondering, when's the other shoe going to drop? When are we going to have the pullback or the correction? And so exactly when we're going to have it, nobody really knows. Well, there's everybody that's making predictions about when it could happen. Some think it could happen or it should have happened already, right? But the idea is when it does go down, when we do have this next correction, which we will have, where it comes down 10 to 20%, on average, it takes 4 months. 4 months, as long as we don't crest over that 20% mark, it's going to take 4 months to come back, right? And so that it should help once you understand the history, right? Once you understand how long it normally takes, that can help ease that feeling in the pit of the stomach that might come from financial stress or financial worry. 4 months, guys, just write out the little correction that's going to happen and then wait about 4 months and it should be back to normal, right? So that hopefully, like I said, gives some people some reassurance. Number two, markets have weathered numerous crises in the past. Right. So let's just go through a list here pretty quickly, because the coronavirus pandemic is unprecedented in its global reach and its effect on both human life and, economies. However, the markets, just like people, are resilient. Especially in America, we say we are very, very resilient here. And we often come back from adverse events with renewed optimism. And we've done that since. So let's consider some of the market events that affected, or some of the events, that affected markets since 1987. And that very first one, 1987, what was that? That was October 19th of 1987, known as Black Monday. So Black Monday here, according to was the Federal Reserve history here, the S&P went down 20.4% in a day. 1 day, down 20%, guys. Woo, that would cause some feelings and pits of stomachs. I'm pretty darn sure. The Dow was down 22.6% during that same time. And so that's kind of crazy, guys. 1 day. It took it more than 1 day to go down that much during the pandemic. However, Black Monday, it didn't reach the 30% drop that it did during the coronavirus pandemic. It was just a little over 20, but it was 1 day. So that's fast. So put yourself in that situation. If that happens, you don't know how much longer or how much farther it could go down, right? So that's the uncertainty. Where this all volatility, where all this uncertainty comes from, is when you're in the thick of it, not knowing. That's it. Like when the coronavirus pandemic happened, we didn't know. Things were shutting down. People were locking down. We didn't know when it was going to come back. That's the thing. When the financial crisis happened, people didn't know when it was going to come back, how long it was going to come back. So that's why our emotions, money, investing, it is emotional. And when we let our emotions get the best of us, that's when we could make decisions that may not necessarily be the best for us. And so there's things we can learn from in history. So, I mean, what caused Black Monday? In the aftermath of it, a lot of regulators and economists identified a handful of likely causes. In the preceding years, there were international investors that had become more increasingly active in U.S. markets, and that accounted for some of the rapid pre-crisis appreciation in the stocks. In addition, a new product from U.S. investment firms known as portfolio insurance had become very popular, and it included the extensive use of options and derivatives, and accelerated the crash's pace as initial losses led to further rounds of selling. And so there were a number of structural flaws in the market that exacerbated the Black Monday losses. So in the years that followed, regulators would address these structural flaws with reform. And so to give you an idea at the time and how that's different from today, we'll go through that. So at the time of the crisis, stocks, options, and futures markets used different timelines for the clearing and the settlement of trades, creating the potential for negative trading account balances and, by extension, forced liquidations. Additionally, the securities exchanges had been pretty much powerless to intervene in the face of large volume selling and rapid market declines. After Black Monday, though, regulators overhauled trade clearing protocols to include uniformity to all the prominent market products. So they also developed new rules known as circuit breakers, allowing exchanges to halt the trading temporarily in instances of exceptionally large price declines. For example, under current rules, the New York Stock Exchange will temporarily halt trading when the S&P 500 stock index declines 7%, 13%, and 20%, in order to provide investors the ability to make more informed choices during periods of high market volatility. And in my brain hears that as it allows people to kind of cool off and maybe start using the logical side of our brain rather than the emotional side of our brain, so that we don't make decisions that could possibly potentially hurt us rather than help us. So in the wake of Black Monday, risk managers recalibrated the way that they valued options as well. And then there were some responses that happened. The Federal Reserve actually responded in a statement on October 20th, 1987. Federal Chairman Alan Greenspan at the time said that the Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. And so behind the scenes, the Fed was encouraging the banks to just continue their normal lending terms. That was it. And Ben Bernanke, writing in 1990, noted that making those loans must have been a money-losing strategy from the point of view of the banks. Otherwise, the Fed's persuasion would not have been needed. But the lending was a good strategy for the preservation of the system as a whole. So they just said, continue your normal lending. That was it. So I wouldn't call that a lot of intervening, other than just the fact that they had to tell the banks, continue doing stuff normal. Because at the time, once again, you're in the throes of it. You may not think that that's the best idea. So some experts argue that the Fed's response to Black Monday ushered in a new era of investor confidence in the central bank's ability to calm severe market declines. I mean, unlike many prior financial crises, the sharp losses stemming from Black Monday were not followed by an economic recession. They were not followed by a banking crisis. And former Vice Chairman, Donald Cohn said, unlike previous financial crises, the 1987 stock market decline was not associated with a deposit run or any other problem with the banking sector. On the other hand, some argue that the Fed's response set a precedent that had the potential to exacerbate moral hazard. And I believe that's kind of where we're at today with all the stimulus packages and stuff like that starts happening. And so stock market quickly recovered a majority of the Black Monday losses. In basically just 2 trading sessions, the Dow Jones had gained back 57% of the total Black Monday losses. And less than 2 years later, stock market surpassed the pre-crash highs. So that took about 2 years to get back after a 20% plus, right? So that would be going into bear market territory now, because remember, bear market is above 20, correction is 10 to 20, and a pullback is basically just like 5 to 9, right? And so that 2 years. Now, that was the response there. So next, we'll kind of go through, since I just kind of started touching on that, it took about 2 years to come back. What are the normal bull and bear market timelines? So if we do have these big crashes, how long does it take to come back? Because we had, in addition to the 1987 Black Monday, in 1990-91, Iraq invaded Kuwait, eventually leading to US involvement. There was another drop in the market. 2000, tech bubble bursts. September 11th, terrorists attacked the World Trade Center and other sites. And March 20th of 2003, the US leads an invasion in Iraq to start the Iraq War. 2008-09, financial crisis, right? 2018, trade war begins between the US and China. And like October, November, December, really, those were bad months for the market. And the market ended up down overall for the year. And then 2020, we had the coronavirus pandemic, and that shut down economies worldwide. So there was kind of a list of some of your some of your market declines, big market crashes since 1987. And what's interesting is now I'm looking at Yahoo Finance, and there's an article which we'll include in the show notes here. According to a research note from Bank of America Securities, it normally takes about 1,100 days on average, 1,100 trading days, excuse me, on average, to retain the territory lost during a bear market. And there's 252 trading days in a year. So that means the average time to get back is about 4.4 years, 4.4. So bear market, that's the average. The one I just mentioned, 1987, it was 2 years later. They had regained all the stuff, right? And so 4.4 years is the average time that it takes to come back. And so, it's pretty clear that if you're in retirement, then that's a much bigger deal than if you are still working and pumping money in, right? If you're pumping money in, your money really doesn't have to be used yet. You're not going to be pulling money out. You're still putting money in. And as a matter of fact, if the market goes down, you're putting more money in, then those dollars are going to buy more shares. So when it goes up, you'll make more money. But when you're on the other side in retirement and you're pulling money out when the market goes down, then that's a bigger percentage loss to your portfolio. And so it's going to take another larger percentage gain for that portfolio to get back to even. And so that's very, very difficult to do. So when we're on the other side of this, when we're in retirement, that's when we don't have 4.4 years to just, think about it. If you're in retirement, you just want to go, for the next 4.4 years, I guess I'm not going to take any income from my investments. That's not going to work, right? And so it's pretty clear that just looking at historical precedents might not help that much. Things are much bigger and wilder than they used to be. And the recently deceased bull market was way longer than its predecessors. I mean, we had the longest bull market in history here after the 2008 financial crisis happened, right? And so, that crash was way faster than any other crash in history, the 2020 coronavirus, right? And so over the long term, just remember, stocks do go up, and most people will assume they will eventually get out of that. But like I said, in retirement, we don't have those timelines to look at. And there's a few, things to look at here. So I'm going to go through. There's another article here by the Hartford Funds, and it's titled 10 Things You Should Know About Bear Markets. And it was a really, really good article. So now that we're on this topic, I really want to go through this, because if we're talking here about markets have weathered numerous crashes in the past, again, I want to give a little bit more perspective so that when they do happen, when, always when they happen, not if, but when, right? So watch for the 20%. That's big. Market cycles are often measured from peak to trough. All right. So a stock index officially reaches bear market territory, like I said, when the closing price drops at least 20% from its most recent high, whereas the correction is 10 to 19, right? And the pullback was 5 to 9. And stocks on average in a bear market, how much do they lose? About 36%, which was pretty much exactly during this coronavirus pandemic what the S&P lost during those 22 days, I believe it was. And so they lose on average 36%. By contrast, stocks gain 112% during a bull market. So just think about that right there. All right, well, if I just leave my stuff in, an index or whatever, and I don't sell, it might go down 36, but it's going to come back 112. All right, that math is positive, right? If the market goes down 35%, I believe it's 54% return that it needs to happen to get back to even. Well, this goes down 36 and goes back up 112. So we're definitely in positive territory here. So that's it. Number 3, bear markets are normal, right? There have been 26 bear markets in the S&P 500 since 1928, 26 of them. However, there have also been 27 bull markets, and stocks have risen significantly over the long term. So think about that. 26 bear markets, where on average it goes down 36. 27 bull markets, where on average it goes up 112. Yeah, we're still in, positive territory. 4, bear markets tend to be short-lived. The average length of a bear market is about 289 days, or about 9.6 months. Average bear market, 9.6 months. Now, 2008 was about twice that. It was about 18 months from peak to trough, right? But that is still significantly shorter than the average length of a bull market. The average length of a bull market, 973 days, or 2.7 years. So the average bear market, 9.6 months, average bull market, 2.7 years. And how often do we have those 20% drops? About every 3.6 years, right? That's the long-term average frequency between bear markets. And so, you may consider the bull market that ended in 2020 to be the longest on record. The bull that ran from 1987 until the dot-com crash in 2000 is another really long one as well. So those two came actually pretty darn recently. And also, bear markets have been less frequent since World War II. So between 1928 and 1945, there were 12 bear markets, or one about every 1.4 years. Since 1945, there have been 14, one about every 5.4 years. So the long-term average is less, but the average since 1945 has been one every 5.4 years. And so maybe, this is a big maybe, right? A big asterisk that is going to be next to this. Maybe, we might not have another one for another, I guess, since we're a year into this now, 4.4 years or so, right, before the next one comes. So this whole correction that everybody's expecting to happen like right now, maybe it's going to be another 4 years. Who knows, right? And also interesting, number 7, more than half, 56% of the S&P 500's strongest days. Let's see here. I lost my spot. Sorry about that, guys. Occurred during a bear market, like right after. Because here's the problem. you don't notice that a bear market has crawled out until after a while, right? And so 56% of the S&P's index's strongest days came in the last or during a bear market, and another 32% of the market's best days took place in the first 2 months of a bull market, before it was really clear that a bull market had begun, before they could actually label it as a bull market. So you've got most of an S&P's strongest returns after a bear market happens really darn close to the trough, really darn close to like the bottom. And so that right there means like, let's not be jumping in and out, guys. Well, let's not be trying to time this, because we might get out here, right? It's like it was here, and then we finally got out here, goes down a little bit, but we don't get back up until it finally, maybe surpasses its old high. And therefore we ended up missing out, actually. Sorry, if you're on listening to this without watching YouTube, you don't know where my hands were when I was saying that. But basically, if the market's at, 3,000, it goes down to 2, you got out at 2,100, and it goes back up to 2,700 before you got back in. Well, you missed out on a lot of that gain. You took a lot of the losses, but you missed out on a lot of the gain. All right. So also, number 8, bear markets do not always necessarily indicate that there's going to be some kind of economic recession. There have been 26 bear markets since 1929, but only 15 recessions during that time. They don't always go hand in hand. All right. And assuming let's just assume a 50-year time horizon, you can expect to live through about 14 bear markets, give or take, right? Although it could be difficult to watch your portfolio dip with the market. It's important to keep in mind that downturns have always been temporary part of the process. So I'm going to use that. I'm going to go back to that 5.4 years, every 5.4 years. So I guess, what does that mean in every, if you're doing a 30-year time horizon, let me break out this here. So 30-year time horizon for retirement, divide that by 5.4, you're probably going to live through about 5.5. So let's call it 6, about 6 different bear markets, possibly during your 30-year time horizon in retirement, possibly 6. So understand they're going to happen. And just make sure you got a plan in place, right? Bear markets can be painful, and this is number 10 in that article, but overall markets are positive a majority of the time. Over the last 91 years of market history, bear markets have been comprised of only about 20.6 of those years, and stocks have been on the rise. Basically, what that means is 78% of the time. That's it. So stocks are up 78% of the time. 78% of the years that we're going to be invested, stocks are going to be up. All right. So we've weathered this in the past. And so what that means is timing the market doesn't work. It's time in the market. The adage of buy low, sell high often leads investors to think they can time the market. But anybody that's been investing for any amount of time knows it's nearly impossible to anticipate precisely when markets are at their absolute low and when they're at their absolute high. And like I said, since so many of the best gains happen after a bear market, really, really close to the time where they hit their trough, then you might miss it. It's like you just miss a few of the days and you've missed out on a heck of a lot of growth. And so that's the thing. More prudent approach is to utilize strategies that just help protect your hard-earned assets and will soften the blow of any future market downturns, right? Utilizing some kind of a financial plan that you follow that was established before something crazy happened, and then you just continue following it because it expected things like this to happen so that you're still going to be okay. That's the thing, right? And so it's tempting to aggressively pursue growth during market highs, but a lot of investors know that balance is the key to long-term success. And so we recommend a few steps to help protect against future market volatility. 1, rebalance, right? Have your circumstances changed? Do you have the same appetite for risk now when it's more recently on our mind than what you did, say, in 2019 when we were still, a decade into our bull market here? So, if you're a client with us, check with us, right? And we got annual reviews coming up for a lot of people, and check with us. Just make sure, and that's one of the things we always make sure to do is like, are we still in line? Are we still good? Is your risk tolerance still in line with how we have you invested? If you're not a client of ours and you would like us to check that out, then get a hold of us. Ask Nate at retirementrescueradio.com. There's probably going to be a link to our calendar in this, in addition to a link to the white paper. There's going to be a link to our calendar for a 15-minute phone call. And so just make sure that your portfolio is properly diversified and balanced to fit all of your goals and all of your risk tolerances. And so that's it. Rebalance, focus, because it's easy to get distracted from your long-term goals when markets are soaring or when markets are being choppy, right? It's hard, it's like when the problem is staring us right in the face, it's kind of difficult to look beyond it. But if you think of it like driving a car, the windshield is right here, but you're not looking at the windshield. You're looking beyond the windshield. That's what we ask to do with markets as well, is don't look right here at what's happening, look beyond it. Even in martial arts, I'm a black belt in Taekwondo. You do not punch your target. You punch beyond your target. You punch through your target, because if you just punch right here, it's like you can just touch it. That's not going to hurt anything. But if you punch through it, and you don't even have to punch very far through it. Punch 2 inches beyond it. That's it. 2 inches beyond your target. Punch through your target. You don't want to just, sorry, you can't see me if you're not watching YouTube. So I just go to YouTube and watch this dumb part right here. It's like if the object, or if your goal, your target is right here, you don't want to put all of your effort into it to where you're punching. It's like I just basically almost punched the screen right there. You don't want to punch 3 feet beyond your target. Just a couple inches beyond your target is really all you want to punch. And that can do, I think even Bruce Lee called it like his 1 inch punch, right? And he's able to do a lot of damage just with that small amount of force, just that far behind a punch. So don't get distracted by seeing the short-term things happen. Keep your vision past your windshield on the horizon. And then just reaffirm, right? You chose and established long-term goals for a reason. Are they still working for you? Does your financial plan still match and move along with those goals? We can always help with that. And if there's any adjustments that need to be made, we can always make those. So that's just it. We want to make sure that we're set up correctly. And when markets are riding highs, another way to possibly, and this is a strategy I've heard of, a lot of people, when markets are going really, really, really well, let's lock some of that in. Let's take some of the chips off the table and start utilizing some principal protected strategies, some principal protected products and investments as well. Or there's some people that will actually buy like income producing annuities with the gain that might happen if they want to take some chips off the table. And think about that. So let's say you've got, I'm just going to use big round numbers. You've got you've got $1 million and the market goes up 10%. That's $100,000. So now you have $1.1 million. Well, you realize, you know what, I'm going to give myself a little bit of a raise. And instead of making it subject to the market, you just decide I'm going to take the chips off the table and I'm going to utilize maybe a bucketing strategy of different types of annuities, right? And possibly get like a 5 or 6% payout, depending on your age and some other factors, right? On that money. So let's just call it a 6% payout, because that means $6,000 a year. So that's $500 a month. So you just gave yourself a $500 a month raise and locked that in for life. And so that could be one way of increasing your income, is take some of the gains that are subject to market volatility and uncertainty. And every time you have some gains, let's lock some of that in, and give yourself a raise and make it certain, right? That's just one example of a strategy that some people use, right? So that's it, guys. I think I have gone through enough of those examples and bored everybody with a history lesson of the markets. But like I said, guys, once you know the facts and you understand what you might be expecting, because this has happened throughout history. And guess what? Every single time something like this happens, they always say, yeah, but this time is different. Yep, it's always going to be different. Every time it goes down, it's different. It's just a different, right? And so we know it's happened. The market is cyclical. Let's just understand that it will come back. Barring a global Armageddon type event or war, maybe it won't, but that we got more stuff to worry about if that's the case than our retirement portfolios at that point, So once again, guys, thanks for listening. I'm going to keep on bringing you content to empower you to live the retirement you deserve. Take care.